Personal finance expert also told savers how to avoid tax. Martin Lewis has issued key advice for savers and warned that some would be paying tax if they have more than £10,000. Speaking on his BBC podcast, the personal finance expert said that people don't get taxed on savings, it's on the interest those savings get. And he also gave advice to savers who are 20 or 30 and said if they are in certain situations then actually not putting their money into conventional savings accounts was the best idea. He said, the more you earn and the more savings you have, the more likely you are to be taxed on your interest. If you are a basic rate taxpayer, a 20% rate taxpayer, you are allowed to earn £1,000 of interest in all savings accounts tax-free. Above £1,000 interest it is taxed. If you are a higher rate 40% taxpayer, you're allowed to earn £500 interest tax-free. People earning more than £125,000 don't get a tax-free savings allocation. Mr. Lewis said that most people will end up avoiding tax on savings if they make the right decisions. This is because they can use accounts such as cash ISAs which protect from tax, and people can put up to £20,000 in them each year. He said, you don't pay tax on savings, it's the interest you earn on savings that are taxable. But most people won't earn enough interest because there are allowances that you're allowed to use, so you won't pay tax. The most important one for taxpayers to know about is the personal savings allowance, which means for a basic 20% rate taxpayer, you can earn £1,000 a year of interest from any source, any savings, you won't pay tax on it. Higher 40% rate taxpayers get £500 a year tax-free, top 45% rate taxpayers don't get a personal savings allowance. But think about this for a second. If you put the money in the top easy access account at the moment that pays 5% interest, you would need £20,000 in it to generate £1,000 of interest. So it's only as a basic rate taxpayer, if you have over £20,000 saved, that you may be paying tax. This also means that a 40% income taxpayer would have £10,000 in the top savings account to cross the tax threshold. Mr. Lewis said, but as well as your personal savings allowance, you're also allowed to save £20,000 a year into a cash ISA. Now, a cash ISA is just a savings account where the interest is never taxed and it doesn't count to your £1,000 a year, so it's an extra allowance on top. You can put £20,000 in per tax year, and the top payers of that are paying 4.76% at the moment, easy access, so you can even take your money out when you want to. So with a combination of the personal savings allowance and cash ISAs, the vast majority of people don't need to be paying tax on their savings. Recently, Chancellor Rachel Reeves decided not to go through with rumoured plans to decrease the top limit on cash ISAs each year from £20,000 to £4,000. The move had reportedly been considered to try to encourage people to invest in UK companies that stick money in savings. But Mr. Lewis said that for some people, actually investing could pay off a lot more, even though the ISA level has been saved. He said, if you are 20 or 30 and you have some spare cash that you can put away that is not going to be imminently usable for you and you're not going to need it for 5, 10 or 15 years, if you put it in a wide spread of investments, could be a global index tracker fund. Then, on the balance of probabilities, that will substantially outperform putting your money in savings, and you will be better off doing so. So the answer for certain amounts of cash you can afford to risk is yes, you would be better off investing if you're doing it for the long term.